News workshop on Tuesdays. My name is Steve Maldonado, and I'm so excited to be back in the chair hosting this week's session. Guys, it's been a long time since I've sat here, but like I said, so excited to be bringing this topic that I feel very passionate about. I'm personally invested in myself, and more so, I've dedicated my time over the better part of the last 2 years here at NewView to helping clients with, and that is specifically passive real estate investing, and even more specifically, passive real estate investing into multifamily and multifamily syndications. Just to give you a little bit of background on myself, I'm the director of syndication solutions here at NewView Trust Company. Myself and my team support investment sponsors. Those are people that are raising capital, and that might be for a variety of projects. However, the majority of the people that we help are those raising capital for real estate projects. So that might be to buy a large apartment complex, to develop one, or a variety of other projects. And so that's what we're going to talk to you guys about today as we move further on into the presentation. Just a quick disclaimer before we get started. NewView Trust is a passive IRA custodian. We custody IRAs, 401ks, ESAs for alternative asset investing. We are not CPAs, attorneys, or financial advisors. And if you do need the advice of those parties, please go seek them out. And we're happy to recommend some of the partners that we work with. But NewView acts in a passive capacity to hold the assets and custody the investments that you're looking to make, but we can in no way provide financial specific advice for your situation. Again, we're always here to help in whatever capacity we can with the IRA specific questions. But if you do need any additional assistance from CPAs or attorneys, please reach out to your preferred provider or reach out to us for some recommendations. So before we get into the nitty gritty, I always want to highlight what is a self-directed IRA, as we have many people joining these webinars in all different experience levels, from people that are just learning how to invest their IRA funds into these alternative assets to very seasoned investors that have been doing this for a long time. So guys, in essence, a self-directed IRA is that IRA in which the account holder has the ability to direct all of the account activity, whether that's the investment choices, where the money's going, etc. But keep in mind that self-direction is really just a marketing term. Okay, again, it describes the account holder's ability to choose the activities that go on in their account. Now, you might be asking yourself, well, Steve, I have that same ability with my Charles Schwab, Fidelity, or TD brokerage, right? The reality is that, yes, you have the ability to choose, but you're limited to the menu of options which they offer. And with a custodian like NewView Trust, your investment opportunities are now expanded to the private markets, cryptocurrency, precious metals, and really anything that you're looking to invest in. And so the concept of a self-directed IRA is really just a marketing term. It's taxed and treated just like a regular IRA. And again, we'll talk about some of those benefits here in just a second, but it puts the power in your hands, the power to choose your investments, investing into a world that is otherwise inaccessible through those brokerages and other individuals who you invest in, and provides you with a lot of different benefits. Again, we'll talk about them here in just a second. Again, there are many benefits to investing in a self-directed IRA, many that we'll get into later on in the slide. But the three main benefits of using a self-directed IRA for investing is diversification, tax savings, and of course, investing in what you know. So we all hear about diversification. If we're savvy investors, we've heard it once or twice. Don't put all your eggs in one basket, right? A self-directed IRA allows you to take all or a portion of your money out of the public markets and put it into an alternative investment. Many alternative investments have outperformed the stock market and can be a great way to hedge against inflation and other risks in the market. So diversification is the first and probably the most beneficial advantage to these types of accounts. The second are the tax savings. So investing through these accounts allow you to invest either tax-free or tax-deferred. And we won't get into too many specifics. There are several videos in our series talking about traditional Roth and all the types of accounts that we custody here at NewView Trust. But just keep in mind that investments made in these accounts are either tax-free or tax-deferred. And depending on how much your returns are, that can equate to thousands and even millions of dollars. And the last and I think most favorite advantage here to me is being able to invest in what you know. Investing through a self-directed IRA allows you to invest in tangible assets, things that you might, drive up the street and see. Again, a multifamily apartment complex, a self-storage unit, or other form of tangible asset. You can use the funds in your IRA account to fund a business startup. Heck, I was working with a partner who was raising a few $1 million to fund their snack startup. And wow, what an incredible partnership it was. People were very excited about that opportunity. But again, it gives you the opportunity to invest in something tangible, something that you know best. In some cases, you may even know the operator, which is not something that you can say for public securities like Apple, etc. So moving forward into why we're here today, NuView again is a passive IRA custodian. It is important to know that investments made in your self-directed IRA must be done at an arm's length, and they must be passive investments. So I do want to talk about specifically passive real estate investing, what that means, and specifically what it means for your self-directed IRA. So what is passive investing? What is passive real estate investing? Well, when you think of investing, there's really two routes, right? Active investing and passive investing. Active investing requires day-to-day management. Passive investing is more of a mailbox money, right? For lack of a better term, you influx your money, you invest your money, and you're paid dividends without having to do much work, right? So active and passive, very similar to anything else that you might think of in that particular capacity. The active real estate investor is that individual that takes over the day-to-day management of that property. So i.e. toilets and tenants. And the passive investor may just be the financial influx or the financial arm of that investment, providing the capital necessary to acquire the property, add value to the property, but has nothing to do with the day-to-day management. And for many people that have more money than time, this can be older people, young professionals, whatever that may look like. Passive investing can be a very attractive approach to investing. It allows you to get into larger and bigger assets than you might not otherwise be able to get into yourself. And again, not have to worry about all the day-to-day and active management of these properties or investments. So I want to talk about two advantages of passive real estate investing. Now, mind you, these advantages are just for real estate in general, right? The main goal of any real estate investor is to produce steady cash flow, right? So again, acquiring a property, adding value, forcing appreciation, and through increase in tenant rents, additional amenities, et cetera, produce steady cash flow, right? Through renters. The second advantage in passive real estate investing, I mentioned it just a second ago, the two biggest headaches in real estate investing are toilets and tenants. Having to deal with the people that live in your property and having to deal with all the capital expenditures that come with managing that property, from HVAC to sidewalk repair to painting the buildings to keeping apartments fresh for turnover. It's a lot of work. And I think that people first look at real estate and they hear about all the great stories and all the successes that people have in real estate. And it's true. People can be very successful, but I'm telling you, it takes a lot of hard work, a lot of dedication, and a lot of time that a lot of people just don't have. And so if you find yourself in a position where, again, you have more money than time, well, then passive real estate investing may be for you. So we'll move on. Again, I talked to you guys a little bit about what I do. I work on the multifamily side, the syndication, working with product sponsors. So multifamily is a little near and dear to my heart. I started investing into multifamily about 6 years ago when I discovered the possibility of investing my IRA into alternative assets. And guys, as I sit before you today, I not only have the privilege of working for, the custodian who I started working with all those years ago, but I've also a portfolio to be proud of. And so I can tell you through experience and also working with the clients that we've helped, that multifamily passive real estate investing has definitely been an avenue for making great change. And fundamentally has changed my retirement, and I know the lives of so many other people. So again, very excited to be sharing it with you as an investment opportunity. Now, there's a lot of murmurs out there. Obviously, nobody has a crystal ball. There's a lot of people trying to figure out, obviously, where we're going in 2024. I wanted to kind of quell some concerns as there's a deluge of information out there coming in from what seems like every digital orifice out there on the internet. But to sum it up, there is still a very heavy demand for multifamily. Now, it's become harder to purchase multifamily because the cost of debt has been high, but people have been creative. And the reality is such that there is still demand, right? Multifamily occupancy ranges from 93% to 95%, which indicates a generally healthy market. Now, this is below all-time highs, but guys, in a time where we're pretty economically uncertain, people following the great resignation, have changed their lifestyle and their habits and behavioral changes. I mean, to see rents, rental occupancy still at 93 to 95% indicates, again, a generally healthy market and something that we shouldn't be scared about. Regardless of what's going on in the debt market, the bond market, et cetera, and how that might ripple through the commercial real estate, multifamily, or other housing sectors, the U.S. is still underhoused by 1 million homes. 1 million homes need to be built in order to satisfy the housing requirements of the United States. That's a lot of property, guys. And so with that comes a lot of opportunity, right, for multifamily, because existing home prices are slightly off all-time highs, but have not become more affordable. If anything, it's even harder today to buy your first home than it ever has been. And so again, for transient people, for younger people, changing the way that they work, lifestyles, et cetera, overall, rental demand has increased. There's still a need for housing. Markets with high development and concentration, yeah, they face problems with fundamentals, but I think still really have strong demographic and immigration trends can still continue to outperform in other markets. We have a $1.5 trillion in debt coming due over the next year and a half, and with that means opportunity, right? People looking to sell properties. I can tell you right now that 90% of the covenants out there with lenders have been broken. And there's many operators trying to scramble to figure out what they do with their properties. Now, lenders are not operators, right? So the banks don't want to take these properties back necessarily, but at the same time, they represent money on their books and they're going to figure out a way to get that money back. And so what that means for investors is that there's opportunity out there if you look. I mean, I was talking to a partner that was able to purchase a property which sold 2-3 years ago for $2.5 million, above asking. Today sold for a $3 or $4 million discount. Can't remember the specific figure, but wow, what a significant discount. And for those people that have money sitting on the sidelines, now's the time to get involved, because those deals will become more and more prevalent, more and more available. But that said, it does take a lot of time to put those deals together. And again, we're not here to talk to you about how to analyze multifamily deals, but more so how you can be a passive participant in these types of deals, letting somebody go out, analyze, do due diligence, and put those deals together for you, so you don't have to spend your time doing it, but can see the steady returns that come from them. So demand and stability in the rental market, like I said, I think that's still strong due to lifestyle preferences, flexibility, and affordability. Think about it. People are younger. People are working remote. People are a little bit more transient. They want more flexibility. They don't want to be tied down. They want the ability to move. Millennials, Gen Z, we're changing jobs every 2 to 3 years. So staying in one place for a long time just isn't, it's just not normal, right? So due to a number of changes, I think that there's still a strong demand for rental properties. Rental housing seems to be more resilient during economic downturns. Like I said, the housing market is still underhoused. That creates this supply-demand imbalance, and it definitely supports rental market stability. And then last is just that rental housing has shown consistent growth. It's driven by factors like population growth, urbanization, shifting cultural attitudes. The reality, again, is that more and more people continue to come to the United States. More and more people will need housing. And so I think that demand will stay pretty constant while the supply remains fairly low. And as economic factors continue to change, as supply chains continue to change, we may even see the strain on supply become even more, ultimately increasing the demand and the potential for investors. So ultimately a positive outlook on 2024. I know that there's a lot, again, of murmurs going on, and we won't talk too specific any more than what we've just covered. But I would say that there is definitely a positive outlook in 2024. We'll talk about looking for operators that have experience in navigating these downturns in the market cycles and kind of what that looks like. But for now, let's go ahead and move on. So we talked about passive real estate investing. And at this point, you may know that there's several types of real estate investing, right? You can go out and you can buy a single family property, fix it up, and flip it. You can buy a single family property and put a tenant in there for long-term rentals. You can build to rent and develop a new property, on a lot in between two developed homes and rent that out. I mean, there's tax lien investing, note investing, private lending in real estate, private equity or debt through syndications. Now, so Steve, Why multifamily? Well, there's a number of reasons that multifamily stands out for me and many investors out there. The first being is stability and the economies of scale, right? Multifamily properties, they offer you the ability to scale. Imagine buying one house and then another one and another one, and having to do that 100 times to own 100 units. But instead, if I wanted to own 100 units, I can go out and buy one apartment complex with 100 units, and I only have to do the work one time. So there's a benefit there to having that economies of scale, having the scalability. This allows investors to benefit from multiple units within a single investment. Now, this can lead to cost efficiencies, reduction in cost of property management and efficiencies, their maintenance, and other operational aspects, which can hopefully and overall enhance returns. Professional property management, that's another one. Guys, day-to-day of tenant management and property management, it's no fun. I'm here to tell you that. Again, with a rental portfolio myself and as a passive investor in real estate, I can tell you managing toilets and tenants is no fun. So professional property management, again, takes more of the guesswork out. It allows those passive investors in multifamily that the ability to leverage these professional property management teams, taking the need to handle the day-to-day and tenant management, property maintenance, and other responsibilities, and freeing up time for their passive investing, or again, even the active investor to go do more due diligence. And we'll talk about some things when considering a syndication or when working with an investment sponsor. One thing to consider is what alignment of interest the investment sponsor, so the person acquiring the property, the operator, has with the property management company. Because and this isn't a property management episode, but property managers don't get paid too much. There historically hasn't been too much alignment of interest between property managers and operators. You've been seeing a shift for more operators to vertically integrate property management. Personally, I look for deals where people have vertically integrated property management. It's just a way to ensure the alignment of interest, and that everybody gets, everybody's happy with the deal, and that nothing suffers as a result of people feeling inadequately compensated. So if you are considering multifamily deals, it is one thing to consider. Ask them if they have a vertically integrated property management company. That's how I prefer to invest. Now, it's not always the case. It's not always ideal to do that for operators, and some operators may be a little bit earlier on in their career, and so maybe they don't have the integrated service or the vertical integration there for property management. But nevertheless, if that is something that's available to you, I always prefer that. And then last thing is mitigating risk through diversification. The cool thing is that multifamily properties don't just exist in one place. They exist all over the country in many different shapes, sizes, forms, and fashions. And so it allows for diversification. We talked about using the IRA as a means of diversifying outside of public markets, right? Bringing your money into the alternative investments via real estate, crypto, et cetera. And this is just another way to diversify, right? So diversifying through geography, property type, et cetera. But definitely multifamily allows diversification. You can spread investments across multiple units, multiple properties. And it also helps reduce the impact of vacancies, right? Economic fluctuations from the pandemic, et cetera, and then other risks on return to investment. And guys, I know that I'm moving a little bit quick. I just think that there's a lot of information that we want to cover, and we do have a short time to do it. If we do have any questions at the end, we're going to leave some time for that. And of course, engage with us throughout social media throughout the week. Post on this video, and we'll answer any questions as we see them come in. And again, if there's anything that you need, we'll tell you where to contact us later on in the slide. So now I'm going to get to the exciting part. That is real estate syndication. I touched on it a little bit, as I'm the director of syndication solutions here at New View Trust, and kind of what that means. Again, we have people attending the live class in a variety of experience levels. And so we'll just cover what syndication is. In essence, a syndication is a group of people pooling their money together for a common investment purpose. In real estate, it's a group of people pooling their money together to buy a large real estate asset that they otherwise couldn't purchase themselves. So like I mentioned before, think multifamily hotel, self-storage, hotel, Yeah, or other form of commercial real estate, what they call mixed use, industrial. It's a larger asset that you otherwise couldn't purchase yourself, and people pooling their money together to go out and acquire this asset together. Now, there are typically two key players in the syndication, right? The active investor, it's called the general partner, and then the passive investors, it's called the limited partner or partners. The active investor, right, the general partner, is responsible for deal sourcing, due diligence, actually putting the deal together, right? They are the active investor. They will operate the deal. They will provide the day-to-day management, the property management, etc. And then you have the LP investor, the limited partner, the passive investor. They provide money for the syndication to acquire the property, renovate the property, add additional amenities, and whatever that may look like. They provide the capital influx available for the investment. So, two players in a syndication, the general partner, and there may be several general partners that make up the general partnership. But again, their role is to be the active investor. And then you have the passive investors, the limited partnership. Again, those are people that provide the capital influx for these projects. The way that a syndication is typically structured, and again, we won't get too specific or too granular, is that a GP, a general partner, the active investor, goes out and identifies a property that they believe has value to be added, that they can force appreciation, that they have an exit strategy, nevertheless, right? They go out, they source this deal. They often will form an LLC. The LLC will then put in an offer to buy that property. And then the syndicator will go out and they will raise money to acquire the property. They'll leverage debt and whatever else that looks like. Again, they're taking on the risk of that debt. They're putting together the deal and they're bringing you a packaged product ready for you to invest. So when you think of a syndication, again, it's in essence a group of people pooling their money together for one common investment purpose. In real estate, it's a group of people pooling their money together to purchase an asset larger than they otherwise could purchase by themselves. So when you're looking here, I'm talking about the role of syndicators in passive investing. This is the general partner, the active investor. So again, they're responsible for deal sourcing, due diligence, structuring the investment, investor relations, asset management, risk management. So everything that you see there. So again, they're the active investor. They're taking all the guesswork out of this investment. So all you have to do is sit back and collect your check. We don't need to get too specific on this. Again, if you have more questions on the syndication process, I'd be happy to talk to you about it. The first step in the process is to identify the deal. Let's find a property that we think that we can add value to, that would return money for our investors. The second step is to do due diligence, right? Underwrite it, go to the property, inspect it, and then make a decision, right? Make an investment decision. Whether you want to decide whether or not you and your partner or whoever you're investing with, whether it be yourself or with people, want to do this investment, right? So you source the deal, you find a partner that you want to work with, you do your due diligence in researching the partner. If you do decide that you want to invest with them, then there's a step called subscription, where you would actually subscribe to the investment. During that process, you're going to sign your subscription agreement and PPM. Second is, of course, your capital contribution. So that's your influx of capital into the project. So that's the money leaving your account going into the investment. Now, finally, you have passive ownership. At that point, you sit back, you collect your checks, you receive ongoing communication and reporting from your investment sponsor. And then finally, you'll receive distributions, hopefully, throughout the lifetime of the project. And then once they exit, they'll return your capital and everybody will be happy. So that's the basic steps in the syndication process is identifying the deal, right? Which you can do in a number of different ways. In-person meetups are always the best way. There's a number of online communities. There's several marketplaces for finding passive investing or finding passive investments in multifamily and other forms of real estate. And then, of course, looking through our video library to see what other partners we've worked with in the past. I mean, we've worked with hundreds of syndicators and real estate investors in the past, general partners, private equity funds. So definitely look in those places to try to find your deals. When doing due diligence, I mean, we talked about a couple things, some key considerations for operators. You want to get a better understanding of how long the operator's been in business, okay? And saying that they've been doing this for 15 years as kind of like a side business. Well, how long have you been doing this as a dedicated business? That's one consideration. I mean, what's their success? How many properties have they purchased? How many have they gone full cycle on? What's their transaction value? Another thing that you can do in your due diligence process is ask them to talk to one of their investors. Say, hey, this sounds great, but I'd love to talk to an investor that's already invested with you or invested with you in a different project, and just get an understanding of how their experience was. If they're not willing to do that, I'll tell you, walk away right now. Okay. Any good operator, any good syndicator is going to give you that referral and let you speak to them. Any good syndicator is going to give you several referrals and let you speak to them. So just a couple considerations when doing due diligence. Don't go with the first operator that you talk to. Make sure that you research them thoroughly, and that you feel comfortable in moving forward with them. Ask for referrals with other people that have invested with them before, and make sure that you ask questions regarding communication, how efficient it's been, how frequent it is. Again, I'm trying to give you this crash course on syndication, something that can last multiple days, and we only have a short amount of time to do it. So again, if you guys have any questions, feel free to reach out to us, and we can kind of talk through some of these things. So I did want to talk about identifying and evaluating multifamily investment opportunities. We did kind of talk about this a little bit. Although the active investor is going to do the deal sourcing and the due diligence and most of the active investing, I would encourage you to be sophisticated about your investments, right? Often we follow social proof. We say, oh, this person says it's a good investment, I guess it's a good investment, let me do it. But let's be smart. This is our money. Let's make it work for us, but let's make good decisions. And so finding deals is not just about locating operators that have them. I would encourage you to listen to what they have to say, but conduct your own market research. Look at the area where they're purchasing property. Is there strong job growth? Is there in-migration patterns? Is Samsung building a plant that's going to bring thousands of jobs to the area? Is Disney moving people from California to Florida? And if they are, how many people are they moving here? Where are they moving to? I mean, conduct that thorough market research. Evaluate rental demand, again, growth potential. What does this area have? What will this area look like over the next 10 years? Don't be afraid to do that. There's plenty of information. Again, we're not real estate advisors. There are plenty of real estate advisors in our network that would be happy to analyze those deals with you as well, should you feel more comfortable working with a professional to do that. So we've mentioned diversification several times throughout this presentation. More specifically, we talked about diversification outside of public markets, as well as diversification through multifamily investing. Now, this class is all about the passive investing, and more specifically, passive investing into real estate. And we talked about syndications. We talked about multifamily, which again holds, a great place in my heart. But for conversation's sake, diversification in real estate reduces risk, it stabilizes income, and it captures potential appreciation. Okay, there are really three ways to diversify your real estate portfolio. The first is geographic diversity, right? So like I talked about before, commercial real estate exists in many forms all over the country, okay? Whether it's here in Florida, whether it's in New York, California, Texas, Louisiana, the point is that you don't have to just stick with one area. Personally, I'm invested as a passive investor in 5 real estate syndications, and they're in various places in the country. One's in Phoenix, one's here in Florida, one's in Virginia, but they're all over the place, right? Because you can never tell what's going to happen in a different area. Florida can get decimated by a hurricane. My property insurance can go up through the roof to a point where we just can't afford to hold on to the property. And you never know, right? So geographic diversification is super important. Property type. So I mentioned it a little bit. I touched on them pretty quick, but there are several different commercial real estate property types, right? So there's industrial. So that could be like warehouse space. You have mixed use. So that's apartments on top, retail on the bottom, hospital on the top, retail on the bottom, mixed use. You have multifamily, which we just talked about, right? So apartment complexes, condos. Then you have like hotels and hospitality. So, and then self-storage, which is another somewhat form of industrial, but it's been put in a category of its own. But anyway, there's so many different property types. So diversification through geographic location, but also property type, making sure that all of your eggs aren't in multifamily, because multifamily can take downturns as well as self-storage and things like that. So making sure that you're diversified across different property types is important. And then the risk portfolio, again, just looking at the different risk profile, some of my investments might be a little bit more risky than others. I feel a little bit more, like the operator might have underwrote a little bit more conservatively than in other deals. But just analyze the risk profile, make sure that you have an even spread of risk profiles across the deals that you do. If one deal is a little bit more high risk, then maybe make the other 3 or 4 deals that you do a little bit lower risk, just to hedge against the potential that your other deal does go bad. So when diversifying through passive real estate investing, again, geographic location, property type, and then the risk profile associated with each investment as well. Now, guys, we talked about a lot today, but the essence of what I talked about is that a self-directed IRA is a powerful but underutilized vehicle. It's been used since the 70s by people to change the way that they will retire by making their own choices and their own decisions about how they'll invest. Again, 6 years into it, and I not only have the privilege of working for the custodian who put me on the path to a better life, but also have a portfolio to be respected, right? So I'm super excited about what it's done for me and all the people that we've helped. And so I would definitely encourage you guys to take the time, get in touch with us. It only takes 15 minutes. The process couldn't be easier, okay? It's 3 steps: getting your account established, getting that account funded, and getting those funds into your investment. After 20 years of doing this, guys, we've made it as painless and as streamlined as possible, digitizing our process. So don't wait. If you have an investment that you're thinking about making, get in touch with us. Let us figure out how we can help you get that made. There is a 7-day right of rescission period. And again, we won't get too specific on what that means, but the point is that there's guards in place to make sure that people like you are protected. It does sometimes impede investment process, but nevertheless, don't wait, guys. Today is the day. Self-directed IRAs are not about having a fortune to begin. It's about having the wisdom to grow what you have into something more. So be smart about your money and get in touch with us. Like I said, the process could never be easier. And the first step is to scan that QR code right there and get in touch with us if you have any additional questions. Now, I do want to turn it to Q&A real quick. I'm getting a flag from our producer over there saying that we have a couple questions that have been submitted. So guys, again, so happy to be here. But yeah, Amy, what questions do we have?
Absolutely. So we had 2 come in. The first one is, are there places we can go to find options for diversifying?
Yeah, absolutely. It's a great question. And I try to touch on it a little bit in the presentation. When I started approaching this realm of alternative investments, it was a little daunting, right? Because the beauty and the burden is that, yes, it's great. You get this powerful vehicle. You can invest in these alternative assets that you otherwise wouldn't have had access to. That's great. That's the beauty of it, right? The burden is, of course, you have to go determine what you want to invest in. And so, it was all word of mouth. It was mostly word of mouth. I was very fortunate, without getting too deep into my story. About 6 years ago, I had a baby boy. I was living over by the college that I went to in a house more suited for the roommates I was living with and a growing family. And long story short, there was a need for my family to find a new place to live. We connected with a gentleman who basically exposed me to the world of alternative investments and was able to mentor me. Now, through that mentorship, he introduced me to people and things like that. So I was very fortunate for that. But through my experience helping clients, they've been successful going out to events. So there's what they call real estate investment associations, or RIAs, in pretty much every city or county across America. That's a collective of people all learning to invest in real estate. So that's definitely a great place to go. Like I said, there's online communities of passive investors, from Facebook groups to meetup groups. There's literally a website called Meetup. That's why I said meetup groups. To marketplaces which feature these investments. We work with a partner called Palace. Palace is a platform online which features these passive investments. You can go through the whole database and search by asset class. It's very cool. So get on the internet. It's really, really easy. I would say that this was something that was kind of kept secret for a long time, but over the last 5 years has become so much more accessible than it's ever been. So get on Google, just do some quick research, and I'm sure you'll find hundreds of communities of people with those deals. Also, look through our social media. Like I said, our YouTube channels, our blogs, our newsletters are cluttered with information from our partners that we've worked with in the past and who our clients have invested with. So definitely look through those videos. If anything entices you as to what they're investing in, most of their contact information is there. If it's not, call us. We likely have it. And of course, we're always great to bounce ideas off of as well. I mean, if I can help, lend any guidance in any way to where to kind of point you. But yeah, in-person events, online communities, and then finding a mentor who's done it before.
Great. And then the other last question from online is, what is the biggest difference between a multifamily investment and single family looking at the due diligence side?
Looking at the due diligence side, obviously it's a scale thing, right? It's all relative. When you're looking at a single family property, you have a lot less to look at, but you're pretty much looking at the same thing, right? You're looking at the structure of the land underneath. You're looking at general bones and conditions of the property. In a multifamily property, you have to look at things like occupancy rate, right? So that's something that's a little different. When you have a single family home, you're really only dealing with one tenant. Like we talked about in multifamily, you have economies of scale where you're servicing hundreds of units at a time. So you're focused more on making sure that you have enough people in those units, to cover your cost, right, of doing business there at that property. So yeah, I mean, as far as, making sure that it's a structurally sound, having tenants in place, looking through pro formas, insurance considerations are a lot different, right? Because you're purchasing insurance on the whole property per unit, not just one unit. You're dealing with this for hundreds of units. So, cost considerations go up. But yeah, those are really like the two differences from the due diligence side. I would say, it's just a scale thing. I mean, they both have, I think, a very similar level of due diligence, keeping in mind that, multifamily, it's like having 100 units in one, right? So you're doing the work for 100 units, but it's not as cumbersome, right? So yeah, I mean, there's not a whole lot of difference between the due diligence side of things. Toilets and tenants is always important, making sure that you have a good structure, making sure that there's value to be added. And then the multifamily side, just making sure that, tenants are in place, rent roll is correct, pro forma, checks out. Yeah.
All right. Well, those were all the questions from online.
Awesome. Well, thank you so much for everybody that participated today. It's been so great chatting with you about, again, what I love most about our little group here at New View Trust. Again, the IRA is such a powerful but underutilized vehicle, and I would encourage all of you to get in touch with us and chat with us a little bit more about how we can help your specific situation. Another thing is, if you are eager to learn a little bit more, you want to participate with us in person, we are having our AltsCon 24 event. I know that it says February here. I'm sorry for the technical difficulty. We did shift the event date to October, but super excited about the AltsCon event. It's an in-person investor retreat where we'll provide education, networking, and this is a great place to find deals to put your money. So check us out at altscon.com and scan the QR code to register now.